Our investment thesis is to invest in growth capital, growth equity, in fast-growing agribusinesses in East and West Africa, with business models that help smaller farmers adapt and become more resilient to climate change. Farmers in Africa are among the most impacted by climate change. Even though Africa's contribution to greenhouse gas is less than 5% globally, but unfortunately, it's the least fortunate are the most impacted.
Tamer, I've been thinking about this conversation for some weeks now. Your story represents something that I'm fascinated by, which is the idea that our lives are not all linear.
Absolutely.
And that sometimes the most unexpected journeys lead to the most meaningful impact. Thank you so much for doing this with me today. I'm really looking forward to it.
My pleasure, Scott. Thanks for having me.
You're an engineer and an inventor with 9 patents who became one of Africa's leading agricultural growth strategists at Cargill, and then launched the Acumen Resilient Agriculture Fund, which is a climate adaptation investment machine that mainstream capital investors can finally understand and trust. That's an unusual trajectory. So let's connect those different worlds and start at the beginning, which for you is in Cairo, Egypt. Tell me about the young Tamer growing up in Egypt. What was the environment like that shaped you?
No, sure. So yeah, I grew up in Cairo, like most Egyptian kids. Grew up, found that my mom is a stay-home mom taking care of us. My dad is a engineering professor. And I grew up in a society that if you like math, you go to engineering school, and if you get good grades, you do your PhD and you want to become a professor. That's the trajectory those days. So happened to like math. I went to an engineering school and got good grades. And then I always dreamed of doing my PhD in the US. Got a scholarship from Drexel, went to Philly, city of brotherly love, and finished my PhD in 2.5 years. At that time, I still believed that I was born to be a professor.
I just wanted to go back to Cairo because you're spending so much time now working on developing Africa. Was there an awareness in your childhood of poverty or development challenges or inequality, or did that consciousness come later in your journey?
No, actually, I have to say that I was always concerned about those who are less fortunate in life. I never thought that I would do anything about it, but I was always concerned about it. I was always concerned about injustice, generally speaking. And I remember when we moved to the US, rule of law is the thing that really impressed me and got us hooked. That was the thing, rule of law. We can always debate about democracy, whether it works or not. We can debate about a lot of things, but rule of law, I don't think we can debate about, or should not debate about that.
Around 1988, you entered Cairo University to study metallurgical engineering. That sounds like serious hard science to me. What drew you to that specific field at that point in your life?
I liked chemistry, I liked physics, and I liked math, but I was good at math, but I was not talented. I was not gifted. So I looked around and I found that the world of metallurgy and materials, generally speaking, is fascinating. My dad was a professor of metallurgical engineering. So early on, I got to get access to his library, listen to his what he's doing, attend some talks, etc. So young kid, got fascinated. And just understanding how materials work and how I don't want to say everything, but a lot of the advancements that are happening in our lives are driven by materials. Like you look at our phones, and our phones have more computing powers than the computer that sent Apollo, right, to the moon. And a lot of engineering is going into that, but it's only because these smart people were able to make those processors so tiny that we could put everything in that phone. So I was really fascinated. So since I was young, I was always fascinated by what I don't know.
You kind of were following in the family business, so to speak. Your father studied that.
Absolutely.
And then when you went to Philadelphia to pursue your PhD, that was materials engineering at Drexel, right?
Correct. Yeah. That's correct.
And what was that transition for you emotionally and culturally when you landed in Philadelphia?
Yeah, it was different. But I have to say that I felt like it was plug and play because it was very structured. You have rules, you follow the rules. And I grew up in a house where we always had rules. I always thought that, someday I will live in a society that's, where rules are meant to be obeyed, where rule of law is, modus operandi. And when I moved to the US, my wife and I felt like it was plug and play. Structurally, it was plug and play. Emotionally, it was, of course, being away from home was not easy. Away from the family was not easy. Just the two of us. But I have to say, professionally, of course, yeah, like any PhD student, you're busy, right? You're working 6 days a week, 12 hours a day. But I think family-wise, it helped us form a very special relationship, my wife and I, where we knew that we have each other's back, and whatever disagreements, we have to work it out. So we have to make it work, kind of.
You completed your PhD studies at Drexel, and you stayed on to work as a research professor under Professor Michel Barsoum on something called max phases, layered ternary carbides and nitrides. You're speaking with someone who barely got through his high school chemistry class. So for people like me who aren't material scientists, can you explain what max phases are and why they're significant, and what was the problem you were trying to solve?
So I have to say that, I was lucky to work with Michelle on my PhD, and of course, like, I have to say, going through a PhD in 2.5 years without having such a supportive wife was not doable. So having a brilliant advisor at school and a supportive wife, we were solving for a problem, and by sheer accident we stumbled on those materials. Okay, so it was not by design, and we were not super smart to design this material. No, we were not. We were trying to synthesize a material that people have been talking about in the literature, that no one was able to make it in large quantities, and we were looking for a super hard material. And the day we made it, it turned out to be machinable, meaning that you can machine it. So it's not super hard, it's not hard, but it had fascinating properties, that to find a material that can withstand those harsh environments, yet you can machine it. That was the aha moment. And then, as they say, the rest is history. But it was absolute accident, I have to say. Good one, a very good one.
It's a good accident. This work you did led to 9 patents, and one of the most surprising, at least for me, you used max phase materials to create formers for manufacturing latex gloves and condoms. Walk me through how you took highly theoretical material science and applied it to a practical high volume industrial problem.
Let me start from the end. We made it work, okay, but it was never commercialized. It's a long story. We were approached by one of the largest producers of gloves and condoms, and they had a challenge with the material that they are using as the mold, right? Ours was very resistant to those chemicals, but we didn't know how to make it in that form. So we had a joint project. And at that time, we were, as a startup, this after I left the university, we were financed by a Swedish company called Kanthal, which is a subsidiary of Sandvik. Together, we developed the process. We were able to actually produce the forms, but for non-performance reasons, the product never made it to actual production. So it performed, but for other reasons, it never saw the light.
Was this in the 312 company that
Correct.
you set up?
Correct.
So you left the university and set up this company.
Correct.
And you never made it to the market then?
Not this one, not this application, no. Which, yeah, and actually it was, it's one of the lessons learned. You learn as an engineer, you're fascinated by how to make stuff, right? How to solve a problem, no doubt. And then, you learn it the easy way or the hard way, that performance is good, but cost is another element, or the product is not ready for the market, or multiple things. So it's not just performance that decides whether a material or a product will be used or not.
When that was going pear-shaped, you decided to pursue an MBA at NYU Stern. Are you explaining the reason why? Because it was a pivot from pure engineering.
So throughout that journey with the 312, I realized that there is a science part of running a business that I don't know. And I thought that time I was 35 years young, and I still can learn. I'm not too old to learn, and no one is too old to learn. So I decided to go to business school and learn the finance part of the business. And so I went to Stern, did my MBA in finance, and I fell in love with finance. So what started as a journey to learn the finance part so I can go back and find another technology to commercialize ended up in a totally different way.
You consulted for a few years when you got out of Stern, but then around 2010, you joined Cargill. That's a pretty massive shift from material science and defense to one of the largest ag companies on the planet. How did that come about, and what was Cargill looking for?
It's a very good question. So if I take a step back, by 2009, I was doing consulting, but you can imagine, I finished my MBA in the year where things started to go south in the US, and things were not going well for 312, and we almost lost everything we had as a family. And while things looked pretty pretty good in the Middle East, and we always wanted to go back to spend a few years for our kids, to learn, about the roots and where they are originally from and be proud of who they are. So we couldn't find a better timing. Yeah, things look fine in the Middle East, not as good in the US. So we said, okay, you know what? We can always move back and explore. And my plan was to continue doing consulting, right? And then 2010, I get a phone call from a recruiter saying that, hey, have you heard of a company called Cargill? I said, of course, who doesn't? And I said, yeah, well, not everyone know about it. And he said, listen, they are looking for someone to manage the strategy and investments in Africa. Would you be interested in exploring? And I said, I think there is a mistake. He said, what? I said, yeah. How many times have you heard of someone starting a corporate career when he is 40? I'm about to turn 40 in 6 months. So he stopped for a couple of seconds, said, actually never. I said, that's exactly my point. So I'm sure there is a mistake for you to call me. He said, actually, they asked me to reach out to you and they want to talk to you. I said, okay, you know what? I like people. I like talking to people. Let me go and see what these guys, all about. Like any serious person about the interview, you do your homework, you learn about the business, what they do, etc., etc. But guess what? I had no clue about the ag business, right? Yeah, I've done a couple of consulting, jobs in food and in food processing, etc., but not Cargill. Yeah, the interview went well, and they offered me the job.
What were they looking for?
I asked. I didn't know until like maybe 10 years later. My hiring manager, we became friends. He was my manager for like a year, and then he moved on within the company. He became the CEO of the Cargill's global sugar business. Had his early retirement, and now actually he sits on the IC of our fund. His name is Ivo Sarjanovic. So we became friends and we stayed in touch. So one day I said, Ivo, I never understood why you hired me. And he said, listen, I hire people for what they can learn, not for what they know. And I always believe that if I can do something, anyone can do it because nothing is special about me. And if people can do it, then I can do it. So, and at the end of the day, even rocket science, I could figure it out. So I'm sure I can figure this out. So yeah.
You joined them as corporate development director for Africa and focusing on grain and oil seeds and leading their growth strategy and M&A across multiple African markets, working in countries like Egypt, Morocco, Ghana, Kenya, Zambia. So what did you learn about African agriculture and supply chains during that period? And what surprised you or changed your thinking about it?
So I did for 2 years for the grain oil seeds business and then moved to the animal nutrition business, which is further downstream. Like Cargill starts from upstream and go downstream, value add. And those 6+ years were unbelievable journey in my life. I cannot overstate how much I learned. Cargill is an amazing school. Okay. It's up to you. If you want to learn, it's up to you. Like all doors are open. So I really learned how the machine works, how the ag machine works from upstream, midstream, downstream, and I understood what happens if a climate event happens somewhere in the world, why fish prices will increase in Kenya, why egg prices might decrease or increase in Uganda, and so on and so forth. So you understand the challenges of the different markets. You understand the opportunities in the different markets. And that's why, when I got that opportunity to join a private equity fund in 2016 out of Nairobi, it's a Swiss fund manager, my wife and I thought it was about the time to keep moving again.
You're talking about your move to responsibility investments.
Correct.
So They contacted you in Africa, or was this in Zurich?
That was it was a recruiter. They were looking for someone to manage the African operations of their ag private equity fund. So again, it was a recruiter, and the recruiter said, well, but the position's in Nairobi. So I talked to my wife, and it was 2016, mid 2016, and she was like, listen, our kids are leaving this year. They're going back to the US for college. So why not Africa? We never lived in Africa. We spent a lot of time in the US. We've been in and out of Europe. So yeah, let's give it a shot. So I said, all righty, let's give it a shot. And it worked out, and I joined.
All this time with Cargill, you were still based in America then?
No. We had moved back to Cairo. So the recruiter called me when I was in Cairo. We had moved back to Cairo, I think 6 months earlier or something.
And Responsibility wanted you to move to where? Where did
Nairobi, Kenya.
I know Ruckus Momarts. He's a brilliant and amazing guy, and he's been on the show previously. But that's a pretty significant transition from a multinational corporation to pure play impact investing. What was going on in your head with that? Because impact is completely different than what you were doing at Cargill.
Actually, if you dig a little bit deeper, you'll find that the differences are not that much. So first of all, investments are investments, right? The analysis is the same on the financial side, right? What people call impact investment, Cargill doesn't call it that way. But Cargill impacts millions of smallholder farmers every day in Africa and in Asia. So Cargill doesn't call it that way. The kind of companies we look for, companies who help farmers become better farmers, this is exactly what Cargill does. By providing, farmers access to markets or better nutrition for their hogs or their lactating cows, et cetera, et cetera. So Cargill doesn't call it that way, but under the hood, the similarities are a lot, actually.
Was there something that started to attract you towards what you now know to be called impact happening over a period of time? And how did that change of thinking come about?
It's actually of course, the pace is different. Okay. When you are working for a fund, the pace is much faster. But also you are closer to the farmers. And we survey the farmers that work with our portfolio companies every year. And when you see that impact, now it's quantified. We're not talking about directionally accurate, right? We're talking about quantification of your impact. And you see that impact on those smallholder farmers, and you see how it changed lives. That by itself is extremely rewarding. Yeah. So if you tell me about what excites me the most about my job, definitely it would be one of the top three things. It's seeing that impact on those farmers.
At Responsibility, you co-led investment transactions that impacted something like 35,000 smallholder farmers. You have spoken about something that resonates with me, and that is the transition from a mud hut to a brick house as kind of being your North Star for impact. Now, when families make that architectural shift, it correlates with being able to send children to school and breaking cycles of poverty. Was there a specific moment during your time at Responsibility, specific deal, or maybe a visit to a farm or community where you saw that transition happen with your own eyes?
Absolutely. Multiple times at Responsibility. And now I always like to go to the field and talk to farmers, right? It's part of RDD. I can't claim I'm at every single farmer visit. We have an amazing team, but I like to join from now and then. And I remember that the first time I hear that comment, it was a farmer in Uganda. We were doing DD on a transaction at Responsibility. And I was meeting with a group of farmers in Uganda, Western Uganda, like middle of nowhere, close to the borders with DRC and Rwanda. And I remember I always ask the same question. I'm a very boring person. I ask the same questions. So I asked that farmer, like, what is it that you like about working with this company? Okay. And I remember him saying that over the past 2 years, I worked with this company, my income increased. And now instead of living in a mud hut, I built a brick house. And he looked behind him and he was pointing to his house. It was just, like you can tell it's a room built from some blocks, right? It's for him, he leapfrogged, right? From living in the prehistorical era to, the modern era, living in a brick house. And And you think about it, and say, gosh, he deserves this and way more, way more. And but for him, that is a milestone. So the first thing those farmers who still live in mud huts, the first thing they do is they build brick houses, right? And so because it's shelter, that's remember the basic needs, right? So it's shelter, it's feeding their kids, and then and then income increases. They start sending their kids to school, and then income increases, and so on and so forth. And then the wheel keeps turning. And once the wheel starts turning, and hopefully it never stops.
Around the end of 2018, you ended up joining Acumen Capital, well-known company. You were appointed managing director to found the Acumen Resilient Agricultural Fund, which I think from now on we'll call ARAF. That's the role you're in today. How did that come about, leaving responsibility and joining Acumen?
Again, approached by a recruiter. And remember, she's telling me that Acumen is raising an ag fund and is looking for an MD with commercial background. And it was at the same time, responsibility was hoping to raise a $250 million fund, global fund. It didn't work out. I think at that time they only raised 70 million. So the decision was made to only focus on Asia. So the decision was made to shut down Africa. And at the same time, I'm getting this opportunity with Acumen, and it's even investing in earlier stage companies, which is, as they say, this where the action is. So I said, awesome. And I get a chance to build something from scratch. And as they say, once an engineer, you're always an engineer. And I like building, right? I like building stuff. I said, you know what? This is my opportunity to do something until I retire and not just raise a fund, but build a platform. And yeah, and now we are raising our second fund. So stage two in the dream that started in 2018, and hopefully it doesn't end ever.
Let's start first with Acumen, well-known pioneer in the investing world, but there's going to be some people not totally familiar with the name, but maybe not exactly. So give me the overview of what Acumen is at its core, and then paint the big picture of ARAF, the structure, the geographic footprint, who your investors are, AUM and all that, just to give the headlines.
So Acumen started in 2001, I believe, if I remember correctly, founded by Jacqueline Novogratz, veteran of Wall Street, who realized that emerging markets, or those who are less fortunate, don't need charity money. They need development. They need investments. Her thesis was to start what she called at that time, non-profit fund, raising philanthropic capital that otherwise would go to charity, raise philanthropic capital, which people who give philanthropic capital don't expect it to come back, invest that in very early stage, very risky, unproven business models that have the potential to reduce poverty around the world. Any money that's made to be reinvested. So that's the non-profit piece of the concept. And gosh, over the years, until 10 years ago, Acumen had invested in hundreds of companies, deployed hundreds of millions of dollars, impacted hundreds of million people, and was instrumental in writing the first check to many very successful businesses today in Africa and in Asia. And around 2015, 2016, Acumen decided to launch Acumen Capital Partners, which is a subsidiary for Acumen, but it's a for-profit asset manager. So now ACP, the aim behind ACP was to manage for-profit funds, typical GPLP structure, right? That raise money from the usual suspects and targeting returning that money plus. Okay, and ARAF was the third in that family.
So before 2016, Acumen wasn't for profit?
No. And still till today, Acumen itself is not for profit, still non-profit, still investing in very early stage, unproven business models that have the potential to fight poverty around the world. Acumen is all about eliminating poverty.
So you were the third for-profit fund that
Yes.
Jacqueline set up.
Correct.
Right.
Correct.
Right. What's ARAF's mission and theory of change? What's the specific problem that you set out to solve?
So, Scott, let me tell you my little secret. When it comes to the theory of change, I can't comprehend. I'm not that eloquent, okay? Because it's a chart that I can barely understand. My team is very good at building it, but I can tell you what our investment thesis is and what we're trying to build. So, our investment thesis is invest growth capital, okay, growth equity in fast-growing agribusinesses in East and West Africa, with business models that help smallholder farmers adapt and become more resilient to climate change. So we're looking for businesses that are profitable or about to become profitable, who are scalable, right? Who have great impact on those farmers when it comes to, or potential great impact when it comes to climate adaptation and climate resilience. And of course, for obvious reasons. Farmers in Africa are among the most impacted by climate change. Even though Africa's contribution to greenhouse gas is less than 5% globally. But unfortunately, it's the least fortunate are the most impacted. So we like to invest in businesses that will help those farmers adapt and become more resilient to climate change. That's our thesis. And we measure that. Actually, we have a grant from the Green Climate Fund and FCDO to actually measure that impact. So we work with a third party to develop the framework of how to measure that impact and report on it every single year to our investors. How many farmers we worked with and how they were impacted.
Help me understand the causality. How does investing in an early stage agribusiness translate into a farmer being able to move from the mud hut to a brick house, as you say? Walk me through the actual mechanisms that does.
Here's the problem. If I start talking, it's not easy to stop, okay? But I get too excited. So I'll give you examples, right? So the first example that comes to mind is pretty much the first company we invested in. It's called SunCulture, okay? SunCulture, basically what they do is that they develop, distribute, and finance solar-powered irrigation systems. Sounds complicated, but it's basically small pump that's powered by a solar panel, right? And what that system does, it allows farmers to have access to a sustainable and reliable source of water. Why? Because the good old rain is unreliable. Okay, they cannot rely on rains anymore. Rain patterns changed, from droughts to delayed rain, etc., etc. So you cannot plan around rain anymore in most African countries. So those farmers, when they have this, reliable and sustainable source of irrigation, they can irrigate when they want to and for as much as they want to, right? Once you do that, and these are numbers, right? I'm not making things up. The average farmer that bought this system more than doubled their yield. Okay? It's straightforward. Same inputs, give them more water reliably, you double your yield. Once you double your yield, you double your income. Okay? Very straightforward. Another example is another company called Hatch Africa, where they sell what is called dual purpose poultry, day-old chick. It's a day-old chick that's designed for backyard chicken, right? The good, like in Europe and the US in the 18th and early 19th centuries, where chickens roam, eat, they grow, they lay eggs, they grow, and you slaughter them at the end of the year. Sounds familiar? But the genetics of those day-old chicks are developed so that they lay more eggs and they build more meat while laying those eggs. And they are resilient to weather and diseases, etc. So now, think about it this way. You're a farmer and all you grow is maize. This is what you know how to grow, right? So your income, whatever crop, your income is seasonal, right? Every season. Between season, you have no income, number one. Number two, well, things happen. You have a drought, you have a climate event. Even that seasonal income might go down. So your income is very volatile, right? So now, if you have this small business in the backyard, okay, that, where you can sell eggs on a weekly basis, increase your income and reduce your income volatility, that's exactly, in layman terms, what it means to be more resilient. So now your income is not seasonal, your income is less volatile, you increase your income significantly, because we have seen some that grew from 5-day-old chicks to 5,000-day-old chicks. So it becomes a business, okay? So having that extra source of income, in the language of business school, diversifying source of income for smallholder farmers is a huge step towards their climate resilience.
Your thesis centers on three different themes. physical resilience solutions, digital market and finance infrastructure, and risk transfer models. Give me the overview and what are the fundamental differences between these categories and how do you think about balancing your portfolio across those three?
Let me try to simplify a little bit, okay? So let's start with the pain points of smallholder farmers in Africa, okay? They're the same pain points all over Africa, same pain points for most smallholder farmers in Asia or other markets. Number one, access to financing, okay? They are not bankable, so access to financing. Access to proper inputs, which is tied to knowledge, access to tech support. And tech support is not only how to grow, but even what to grow. Okay. Because they might be growing something that everyone else is growing, and then you have surplus and prices go down. So, and the technical advice of what to grow and how to grow it, what kind of inputs. Okay. And if you have access to financing, so you can finance those inputs. Otherwise, you'll count only on the cash you have. And if you are poor and you don't have enough cash, you're not going to buy all the inputs you need. You're going to cut corners, right? And then your yield will go down. And if you have everything available, but you don't have access to market, then still a problem. Double your yield, but if you don't have reliable access to markets, then there's a problem. So now we try to invest what we call platform businesses. Okay, platform business are business that address more than one pain point of those farmers. So the aggregator business model could be a business model that, for instance, buys cocoa from farmers, like a company literally we invested in. They source cocoa from organic cocoa from farmers in Madagascar and Uganda. During the season, provide those farmers with agronomy support, etc., etc. And at the end of the season, they are a guaranteed off-taker. So guaranteed offtake of that cocoa. And by the way, they turn that cocoa into chocolate bars in Madagascar. And next time you go to Whole Foods, and you can delete that if you want to consider it a advertisement. Go to Whole Foods, and the only chocolate bar that's made in Africa, it's called Beyond Good. So now they connected those farmers to a value add product in country and then sell it in the US. Unlike most chocolate bars which are made in Europe or the US. Okay, so this is an example of that kind of platform business. It can be a business again like SunCulture that gives them access to financing, right? So you're financing a productive asset, but at the same time using technology, they provide them with agronomy support, right? And so on and so forth.
Your fund one, what was the AUM on that?
58 million. We actually, when we started, we thought that we want to raise a $50 million fund just to prove that we can find those kind of businesses. Because when we launched that fund, it was the first equity fund globally to be focused on climate resilience of farmers.
US dollar, right?
Yes, US dollars. And now we're raising our second fund, which will be 120.
Walk me through ARAF's investment process. How do you define your investment universe? What's in scope and what's out of scope at the top of your funnels?
So the two asset tests we run, one, do they work with smaller farmers? If the answer is no, then it's a very quick no. Okay, that's the fastest no ever. Okay, do they work with smaller farmers? And then the second, look at whether it's commercially viable, unit economics, etc. But does this business model have high probability of positively impacting smaller farmers' climate resilience? We judge that. There is a tool actually that was developed by Acumen and Winrock that can measure that. You answer some questions about the business model, et cetera, and then the tool would calculate the climate resilience impact, whether it's low, medium, or high. If it's not high,
what's this tool called?
It's called WinRes.
WinRes,
and it was because it was co-developed between Acumen and Winrock. We get a free license to use it. So that's another perk of being part of the Acumen family.
As you move down on your screening process, what are the financial screens and the non-financial screens?
Sure. So the financial screens, like any fund, we look at margins. The first thing we look at is unit economics, okay? Because if it's not solid unit economics, we're not interested. Unless it's very early and we want to bet on the team and the idea and what they're trying to solve. And we've done only 2 of those, but usually we like to invest in businesses with solid unit economics. That's the least, that's the starting point. And then we look at their historical performance, we look at growth rates, we look at their margins, we look at the potential of that opportunity in that market and in other markets. Because, like, people talk about Africa as if it's one market. Africa is 54 countries, and most of them are smaller markets. So we like to see a business model that is replicable in other markets in Africa. We want to see good returns for our investor. And that's the goal. And as a matter of fact, already we started liquidating some of our positions, sending money back to our investors. It's always good to send money back the other way. So we already started doing that.
What is your target return to your investors?
We're in the ag space, so we are targeting net returns of 11 to 12% on the dollar, which in the ag space in Africa is considered pretty good.
A lot of what you're doing is blended capital. Is that true?
Correct. Correct. Yeah. The first fund, we use blended financing, and the second one would be the same. The ag space in Africa, first of all, we don't have many investors that are interested in Africa. And those who are interested in Africa, they will look into an ag fund and a tech fund. And of course, the potential returns are not as good on the ag side. So you will find that not many people are excited about ag in Africa. So we had to use blended financing. Basically, the Green Climate Fund, our anchor investor in the first fund and the second fund, offered what people call first loss layer, right? So, okay, I'll be the one that de-risks everyone. In the first fund, they give us 40% of the fund to de-risk everyone else. And in the second fund, they are giving us 25% to de-risk everyone else. Basically sending the message that, okay, as an investor, yes, you might be seeing other opportunities that promise higher returns, but it's higher risk. So what I will do, I offer you lower risk, even if it's lower return, but it's lower risk. I'll take care of the risk.
You described one of your first filters as, is it scalable and is it for small holders? So how do you think about adoption and affordability, distribution, which are the pathways to scale? Because that seems to be like the make or break factors for anything serving smallholders is they have to be able to adopt it rapidly so that you can get it to scale. How do you approach that?
So we have come across many business models. When we start analyzing the business models, you find that, yes, it looks like it has the potential to work with hundreds, if not millions of smaller farmers, but farmers are not willing to adopt that because, for instance, as someone is using technology to provide a service, farmers are not willing to pay for that. They don't have the money to pay for that. So adoption is extremely important because farmers, not only in Africa, everywhere, farmers are very conservative, right? They are extremely conservative when it comes to changing their habits. So changing their behavior is not easy. So if you think that you will come overnight and change their behavior, it's not going to happen. So you need to see the traction. If it's a new product or a new way of doing business, you need to see the adoption rate, okay? How long it takes for farmers to adopt that new product or service. If it's radical change, most probably it's not going to happen. So farmers like, smaller changes, because if they try something totally different and it fails, it's going to take them another year to go back to what they were used to.
What is your exit strategy? Is it trade sale or any of these going to the public markets?
We invest early enough that even if any of our companies become so big to go public, it will be beyond our investment period or our holding period or our fund lifetime period. It takes time in our sector for companies to grow in Africa. Our sector is cyclical, right? It is slow by nature. So the exits we had so far, we sold to other investors, larger investors that are willing to invest in companies at a later stage. We're talking to a couple of strategics about selling some of our holdings. But IPO, no, I don't think it's a route that will happen in the lifetime of the first fund, no.
So your specialty is being on the ground in Africa. When you walk into a pitch meeting with a first-time founder in Kenya or Ghana, what's the one thing you're looking for that tells you this person actually gets it versus someone who's just read too many Silicon Valley blog posts?
Oh, it's an excellent question. So, we're sector focused, right? That's the only sector we know. That's the only sector we understand. So we can claim that we know what questions to ask when it comes to understanding the sector. So we make sure that they really understand the challenge. So it's not going to be a walk in the park. Okay, it's not going to be a hockey stick. Hockey sticks don't exist in our sector in Africa for sure. So any hockey stick in any presentation is a deterrent. Like any investor, we look at the personality of the founder, a founder that listens and reflects. It's super important. We don't want founders that follow what we are saying. To the contrary, actually, we are investing in them because they're entrepreneurs. They take risks. They see what no one else is seeing. But at the same time, also, you want to see that you're investing in someone who listens, who listens to the board. And if the board is challenging, and if everyone else saying, don't do this, you're not stubborn. So these are the kind of traits we're looking for.
We've talked about blended finance, and Green Climate Fund has been there, I guess, from the beginning. And I guess they provided the first loss layer. Why was that necessary to unlock capital for climate adaptation and African agriculture?
So put yourself in any investor's shoes 7 years ago, okay? Acumen, who's used to be a nonprofit, is showing up to raise a for-profit fund with a first-time fund manager, okay, with a very unorthodox thesis around climate resilience. And at that time, resilient agriculture was not a sexy word. Now, right now, it's a very sexy phrase, by the way. But when we raised that fund 7 years ago, it was not a sexy phrase. So put yourself in any investor's shoes. Would you bet on a first-time fund manager raising a fund in a tough region, in a very tough sector, raising the flag of an unheard of thesis, unproven thesis, and would you bet your money on them or someone else? More generic, more proven thesis. Of course, it's the latter, right? So to make life easier for you and make it more attractive, we say, okay, by the way, 40% of the fund is de-risked. So if you are so worried that we lose your money, don't worry, someone else is de-risking that for you.
And how does that play in the second fund? Are they taking a bigger role or a smaller role, able to decrease the...
Bigger ticket, but smaller role.
So you're benefiting from the experience of the first fund.
Of course.
And you've shown that you can do that.
Yes, absolutely. But we still needed some de-risking for those who are like new investors who are still like, should we really do this? We say, you know what? Hey, 25% of the fund is de-risked. You shouldn't worry about the risks. So we were able to attract new investors to join the second fund. And we're really optimistic about reaching the target size, but only time will tell. But fingers crossed, we're going to have our first close very soon, and we're very excited about it.
You're an engineer. How does your engineering background shape how you think about blended finance structures and this business?
I think it's all like, when you think about it, it's common sense.
Yeah.
Yeah, it's nothing. There's no rocket science. It's very straightforward.
No. I found something called the Technical Assistance Facility that sits alongside the fund. Explain what that is and how is it funded and why is it necessary?
Yeah. So again, remember, developing the thesis of the first fund, I was not part of it. It was developed at Acumen, right? I was hired afterwards to raise the fund. But the thesis itself was built on years of experience investing in those ag businesses in Africa and Asia and Latin America. And from the learnings, Acumen came up with the climate resilience thesis, right? So one of the learnings was those earlier stage companies, there are things that they would like to do, but they cannot afford it because they don't have the money for it. So they need grants. So the idea was to have a vehicle that will raise grants, okay, from funders, with the idea of using those grants to provide them as grants to those companies to do multiple things. The first thing that we use this TA facility for is to hire a third party to measure our impact. If it's not measurable, it doesn't exist. Okay. So a lot of people think that an impact fund means targeting lower returns. I fundamentally disagree because a fund is a fund. Okay. An investment is an investment, and you should not be accepting lower returns because of the impact. The way I look at it is that an impact fund is a fund that has an impact thesis, and that fund measures that impact and reports on that impact. Either you're an investor or you're not. If you're an investor, you're going after returns. If you're not, that's fine. We can call it something else. But an impact fund should have a clear impact thesis and measure against that thesis and report against it. So when we said that our impact thesis is to improve the climate adaptation, climate resilience of farmers, we had to develop the framework and hire a third party that we co-develop that framework with to actually measure that impact. Call farmers, ask them questions, and have those data. And actually, recently, we published a report because we realized that, well, it's been 5 years, we collected over 5,000 data points. Let's report on what we learned. So far, we are only reporting to our investors. Let's report to everyone and get feedback and improve what we are doing. So part of that TA is to hire that third party to measure the impact, right? A second part is to help companies with business development and capacity building activities. Like, let's say a company, the founder really believes that an ERP system would bring a lot of value, but they don't have the cash for it. We give them 75% of the cost. They want to hire a go-to-market strategist, okay, for a new product or a new market. We pay 75%. Let's say that there is a middle manager that needs a coach, so that middle manager is ready to move to the C-suite. We pay 75% of that cost, and so on and so forth.
Where's that funding for that facility come from?
Love it. Excellent question. So part of the money comes from investors in the fund, like the Green Climate Fund, FMO, Proparco. These are existing investors in the fund, right? So they give us grants. And then you had funders that are not LPs in the fund, but wanted to support what we're doing, like FCDO in the UK, funded by the UK government, and IKEA Foundation. IKEA Foundation was super generous. Not only they gave us money for the TA, but a condition for the first fund was for Acumen to become an LP. As an NGO, Acumen doesn't have cash sitting around to become LP in a fund. So Acumen actually raised a grant from IKEA Foundation, $2 million to become that LP. So IKEA Foundation was very generous, not only supporting the TA, but supporting Acumen to become an LP.
This is pure grants, right?
The TA? The TA is pure. Yeah.
What's the size of this? Is it funded annually or is it funded for the life of the fund?
We're committed at the beginning or throughout the fund. Like at the beginning, we raised 4, and then another one came, another $500,000, so a total of 5.5 for the lifetime of the fund. We are just a pass-through, right? We manage it, but it's all driven by the company. It's the company that has to decide what is that they want to do and deliver that project so we can reimburse them.
Let's talk a bit about risk. You're operating in tricky places, frontier markets, and you're backing early stage companies, and you're serving the most vulnerable populations. So what are the main risk categories you're actively managing every day, and how are you approaching that risk? And then you've got currency risks on top of all that.
Yeah, currency risk is always top of all of that, top of the list. Macro. So let's call them macro and micro, right? So macro risks come at the top because these are the most unpredictable. A government waking up in the morning and closing borders to importing or exporting something that your company counts on or sells or buys, right? And it happened actually. A currency that is devalued by 50% overnight. So the company grows by 100%, but then suddenly 50% of that growth is gone because of the currency. Because we invest in dollars and we are assessed on the dollar's returns. So how we mitigate those risks, like for instance, when it comes to the currency risk, we try in our portfolio to have that mix. We have companies that only export, so their income is purely in dollars, right? Or a company that is selling locally a product that is priced at import parity. So yes, it's priced in the local currency, but it's priced based on the imported product that's in the places, right? So pricing at import parity is another tool. But you cannot hedge, for instance. You cannot hedge the currency because hedging African currencies is extremely expensive. Yeah, no one does that. Even the multinationals don't do that. So you factor in that the currency will depreciate and you factor that in your calculations. And you hope that no extra factors will kick in because they always do.
What about measuring impact? It's always the devil's in the details. and you're dealing with farmer-facing models. How do you verify impact when you're reaching farmers through intermediary businesses?
So the best way of doing it is actually we cannot do it ourselves because we'll be biased, right? Because part of our carry is based on the number of farmers we impact. Like any fund, we have the financial hurdle rate and we have an impact hurdle rate. Okay, so we hire a third party that will call farmers in their local language and ask them those set of questions. And of course, the sample is always statistically meaningful. And then we analyze the data. Okay, and that's the only way to measure the real impact. Is it scientifically accurate? I think it's directionally correct. We're far from claiming that it's scientifically accurate. As a matter of fact, recently we started working with a business school in Europe to slice and dice the data we're collecting to see what are the real levers behind climate adaptation and climate resilience. Because maybe we're asking too many questions. Maybe there are things that we need to focus on, things that we need to eliminate in our surveys, and so on.
You use third parties. Are these international firms or are they all local firms?
Oh no, the one we are using, it's called. Can I mention the company's name?
Sure, of course.
60 decibels. It's called 60 decibels. 60 decibels. They use what's called lean data surveys. The company headquartered in New York, and they have offices all over the world. As a matter of fact, just as a disclaimer, the concept of lean data surveys was developed at Acumen originally. Actually, there are, I think, 2 or 3 Harvard business cases on lean data surveys, because at one point, lean data surveys were the gold standard in climate measurement. And then it was spun off as a company. The lean data team led that spinning off, and now it's an independent company serving our funds as well as many others.
I'd like to walk through a few real-life portfolio companies that best demonstrate your thesis. And if you could maybe start with a good example of your physical resilience investment theme.
Yeah, I think as I mentioned earlier, the solar powered irrigation company is a very good example. A very, very good example. The backyard chicken is a very good example. We have a company in Ghana that actually connects, they don't connect farmers to local markets, they connect farmers to international markets. So they get the orders from, or secure demand from, international buyers, and back to back, they sign contract farming agreements with smaller farmers. And they walk the journey with the farmers. They provide the proper inputs, which is an in-kind financing, right? They provide the tech support. They make sure that the farmers, the yield is as high as possible and the quality is as good as it gets, because it's for exports, right? That means that they can charge more for the same crops because they are selling it for more money overseas. Farmers are paid more, so farmers make more money. Farmers grow what they can make most money out of. They don't grow what they are used to, because farmers usually grow one of two things: either what they are used to, or what their neighbors made money growing the previous season. So those two theses are not the best, because in the first one, you're only growing what you're used to, and it's not a good idea. And the second one, if everyone does the same, then suddenly the whole village is growing the same thing, and then you have oversupply. So if you have someone who's saying, grow this for me, and this is how we're going to grow it, I'll provide you all the inputs, and I'm going to buy all your product. This is gold for those farmers. And not only that, company will tell you, oh, then you need to rotate. You need to rotate between the crops, and you need to best practices. Now we are talking about best practices. Not only how to grow that crop, but what to grow before, what to grow after, in seasons, how to take care of your land, soil health, and so on and so forth. All of these elements, if you look at the questionnaire for climate resilience, you will find all these practices embedded in that questionnaire.
At what stage were these companies operating at when you first invested, and where are they now? What's been the evolution of growth of those companies?
So many of the companies we invested in, they were not profitable at that time. Many were just about to be EBITDA positive. invested in two. Actually, it was, I think, two companies that were just greenfield, like pre-revenues. Now in our portfolio, we have companies with revenues exceeding $50 million, which I know in the US is not much, but in Africa, that's a lot. We have companies that actually, end of last year, we received our first dividends check from one of our companies. So our portfolio overall revenues, if I remember the numbers correctly, grew more than 3x. And every dollar we invested brought more than $5 in other investors' money. I remember joining to raise the fund in 2018. We had our first close towards the end of 2019, and we started deploying in 2020.
So you have about 5 years into the
End
fund.
of 2029. This is when hopefully we are done. We'll have to ask for an extension.
How about an example from your portfolio that fits into your thesis around bundling and aggregation?
Yeah, that Ghanaian company works, that fits extremely well because remember, when they get the demand for, let's say, 500 tons of chilies, you cannot have one farmer supplying all of that. So you need to work with thousands of farmers and aggregate, right? If you look at that company, and now I think they work with more than 7,000 farmers. So overall, if you look at our impact scorecard, the first thing we report on is how many farmers work directly, not indirectly, directly with our portfolio companies since day one. And now we have exceeded the 3 million mark, end of last 25.
Fantastic. Congratulations.
Thank you.
Walk me through an example of how digital infrastructure creates resilience for farmers.
So I can give multiple examples. One of them actually is a company we invested in that leverages weather data to develop insurance products for smaller farmers. So basically, one of the challenges, if you look at the climate resilience of farmers, one of the biggest challenges they have is when a climate shock hits. Well, if the farmer does not have savings, as most of them don't, right, because they are poor, or they don't have insurance, their ability to absorb that shock becomes extremely low, right? And as a matter of fact, if you look at when we measure climate resilience, the farmer's ability to absorb a shock has been extremely low and has not improved at all since we invested. Why? One, insurance is not readily available, right? Two, farmers are starting from a very low base. Even though more than 80% of our farmers reported increase in their income, still, when you start from a very low base and your income increases, and part of that income increase is consumed by inflation, and the other part you're using to build a nicer house or send your kids to school, or for taking care of the health of the family, savings becomes a luxury. So we still have a lot to do, and we here is not just ARAF. We as a community of investors, donors, etc. It's a long journey. Keep in mind that more than 30% of the farmers we work with are below the poverty line. And even those who are above the poverty line, and I'm one of those who are not big fans of the poverty line, because what does it mean? Yeah, it's a nice line that we measure against, $3.2 a day, roughly, give or take, depends on the country. But farmers who make $5 a day, I haven't seen anyone of them riding a Mercedes. No, they don't. They're still poor. They're not below the poverty line, but they're still poor. So most of the farmers work with, because they're all smaller farmers, are poor. And I remember once I heard in a podcast, I believe it was Jacqueline Novogratz, our founder. I believe she was the one that said the opposite of poverty is not wealth, it's dignity. And that it resonated a lot with what we see on the ground, because that's what you want them to feel. You don't give them a charity, you don't give them a donation. You help them become better farmers. When you hear a lot of people saying that, smallholder farmers should not farm, all this land should be aggregated, and we do commercial farming. Yeah, sure, that's one way of doing it. But I'm sorry, who am I to tell someone who wants to be a farmer, don't farm? If they want to be farmers, let's help them become better farmers, more effective farmers, more productive farmers.
You just mentioned that ARAF targets 30% of beneficiaries who live below the poverty line that you just discussed. But you also have specific gender mandates. And The fund supported innovations like AgroMall's Transform Score, which uses alternative data for women who lack land titles. Walk me through, how do you operationalize gender smart investing in your due diligence and portfolio support?
So first of all, we do not target 30% below poverty line. This is the actual data. So this is what we measured.
So that just ended up that way. It's not a target.
Yeah, this is what we measure. Actually, it's close to 38%. Okay. And we do not have a gender mandate. We measure our impact on gender, the impact of gender on our thesis. Okay. So we don't claim that, hey, we go and target, female founded company, or we target female farmers, but we measure how many farmers that our companies work with are females. And do we see any difference in behavior between female farmers and male farmers? And absolutely, no doubt about it. We have the data to support it. We found that, same company, same product, right? We measure the NPS. One of the things we measure is NPS. You'll find that the same company, same product would score higher NPS with female farmers than male farmers. Female farmers appreciate more the value that those companies bring because, first of all, their expectations are lower because they're starting from, unfortunately, a lower base. I remember, I can never forget that, talking to that female farmer, and it happened multiple times, talking to female farmers that are using those solar-powered irrigation systems. So when you talk to a male farmer and you ask, okay, what is it that you like about working with this company? The first answer is always, oh, it increased my income. Standard. Male farmers love it because it increased their income. Bingo. You ask a female farmer, and the answer is, the first one I always got was, my back doesn't hurt anymore. And then you reflect on that and say, yeah, because if she doesn't have a pump, she will be the one that will have to go and fetch the water, right? With those 20 liters jerry cans, or operate a manual pump. So that's quality of life, my friend. So she's saying that the first thing, her quality of life improved significantly. Number two, she says that this pump now provides her with more clean water for her kids and her cows, because we have the data showing that giving those cows more water increases their milk yield by 50%. And guess who takes care of the cow in the house, or the livestock in the house? It's the female farmer. It's the wife, right? The third one is increasing income. That's why we always measure the quality of life of those farmers. We have part of the surveys we run about the quality of life. But now we see a huge difference in gender, and so on and so forth. We have tons of data to support the differences in how female farmers respond to different products and services that our companies are offering.
Let's zoom out a minute, and I'd like you to talk me through the $1 trillion blind spot in global climate finance. The vast majority of climate capital is chasing mitigation, things like renewable energy, electric vehicles, carbon sequestration. But only 5% of the investment goes towards climate adaptation. Why do investors perceive adaptation as higher risk? And what are the proof points that are needed to unlock that capital?
It's an excellent question. Really love it. So when you talk to people about climate adaptation, they always say, "Oh, climate adaptation, that's a government play. This is not for private sector." Okay. Because for some reason, people always think of infrastructure, always think of dams, always think of stuff like that, right? People don't realize that actually there are sectors where the private sector can invest profitably that directly results in climate adaptation. And agri is the obvious. That agri is, it has become the poster boy when it comes to private sector investments in adaptation, because you are really helping those farmers adapt, and you can measure it, right? Now we showed that you can actually measure it. But again, I don't want to say what we're doing is a drop in a bucket, because it's really a drop in the ocean. But Scott, oceans are made of drops, right? Of raindrops. So hopefully we see more coming. We don't want to see a lot more coming immediately, because if you just pour tons of money immediately what will happen is that, you start seeing some, irresponsible behavior, if valuation goes up and so on and so forth. We want to see more money that's directed in the right channels. Like one of the channels that I always talk about is, again, if we go back to this pump, right? Simple pump. The farmers paid over 30 months. It's like what, $40 a month. Okay. So, and down payment is like $80. It's not much, right? Guess what? For many, like most farmers, most small farmers in Africa, that's a lot of money. So what makes it that expensive? Well, because when you finance over 30 months in Africa and you are borrowing as a company at 15% on the dollar and you factor in default, et cetera, by the time, and you're factoring in depreciation, by the time it reaches the farmer is financed at like 20%. And then you say, okay, why don't we subsidize those farmers to have access to those productive assets like irrigation, et cetera? And that's when you are accused of distorting the market. No, we don't want to do that. We don't want to distort the market. If we offer low interest loans, etc., that's market distortion. And I'm sorry, we don't have a market to start with, Scott. Like we have a bad situation, a sad situation to start with. However, I would like to ask those who are so against that concept, why is it okay to subsidize American farmers and European farmers and not poor African farmers? Like, why financing poor African farmers will distort the market while, if a farmer in the US or Europe wants to install irrigation, we all know that they have access to very low interest rate loans, right? I think in the US overall, it's like what, 40, $45 billion? And in Europe, it's close to 50. So yeah, farmers are subsidized all over the world. But you mentioned the S word in Africa and people freak out. I'm not saying you should give handouts to the farmers. They don't want handouts because it's demeaning. Handouts are demeaning. But if you can actually, we ran that experiment, and if you can lower the price of that pump by 25%, sales velocity increases by 3x. So data is out there. Data, no doubt about it. And research showing that if a country like Kenya invests $200+ million over 5 years in irrigation, solar powered irrigation, the company can reach, food sufficiency. The research is out there, but the cost of capital is high. So it's not, we want just capital to be invested in adaptation. It's how and in what tools, in what financial instruments. I think it's more important.
You've mentioned ARAF 2 fund, and I believe you're expanding your investment activities into North Africa, including Morocco and your home country of Egypt. Egyptian agriculture is pretty different from East African agriculture. It's heavily irrigated by the Nile rather than being rain-fed. How does your resilience thesis change when you're moving from rain dependence to river dependence? And then how do you think about the geopolitical tensions around the Nile's water supply?
It's different, but it's different when it comes to irrigation. Egypt is among very few countries in the world where it's 100% mechanically irrigated, right? Most farming around the world uses rain one way or the other. Or when there is irrigation, it's supplementary. Unlike in Egypt, it's like modus operandi. However, unlike what most people think, Egypt agri-sector is based on smallholder farmers. As a matter of fact, the average farm size in Egypt is smaller than the average farm size in Kenya. Okay, water might not be the issue now, but it's whether climate events are not just water events. It can be heat, it can be cold waves. A cold wave, a heat wave can destroy your crop, right? Add to that, there is an opportunity in Egypt to use, and still already, of course, many are using more water efficient techniques, but there is room for way more. Because as I said, the tension around the water, the Nile, how much water will Egypt be getting in the future, et cetera, which 70% of Egypt's water is used in agriculture. And many farmers are still using furrow irrigation. So using more, water efficient techniques. There's a lot of room.
ARAF 1 is structured, I believe, as a 10-year fund. Is it 10-year?
That's correct.
Yeah. And That's considered patient capital in the VC world. But in agriculture, a tree crop might take 5 years just to mature. So is the standard private equity 10-year fund cycle fundamentally broken when you apply it to agriculture?
Wow, it's spot on. It's a debate that's been going on for a long time, and you will find that actually investors, most of them agree that this is not the proper structure, that an evergreen vehicle is more appropriate than the 10 years. Not just because of the trees, etc., because your farmers can be doing something else, like even poultry, etc. It is just, it takes time. If you are in Africa, things take time, and you have events, you have macro, etc., etc. But keep in mind that those investors, they are structured to finance the 10 plus 1 plus 1. So they might think that, yes, you're right, Scott, evergreen makes more sense for agri. But sorry, Scott, we're not structured to finance those vehicles.
Step back and give me your view on the future of this space. What needs to happen to mobilize significantly more capital into the climate adaptation for smallholder farmers? Is it about proving returns or changing regulation or creating more blended finance vehicles? What's the bottleneck you see here?
I think number one, we need to show investors that this is a sector where you can invest and send money back plus to your investors. Okay, bring that confidence to investors. Okay, I think that's number one. Number two, at the macro level, we need to work with different stakeholders to bring that lower cost of financing instruments, or instruments to lower the cost of financing. It doesn't have to be a subsidy. It can be, a currency hedging pool of capital. Okay, that foundations put together to hedge the currency for the sector or for those companies, and so on and so forth. I think if we can have the first, and then we can have the second, hand in hand, I think the future of that sector is very bright. Because right now, even with the limitations, we see companies making money and returning, good returns for investors. But we need to see more, way more.
What do you think is misunderstood or underestimated about adaptation investing by the mainstream financial institutions?
I think Scott, if I take a step back, there is a misconception about investing in the ag, generally speaking, the ag sector, generally speaking. And we got that response with the first, of course, now it's less, but still there, which is no one makes money in ag. Okay. Oh gosh, I got this response so many times. And I will say, no, I'm sorry, companies are making money in ag left and right in Africa. Yeah, but not working with smaller farmers. Not really. Actually, the coffee cup that you and I drink, that coffee is grown by smaller farmers, and companies are making money out of that coffee. And the chocolate bar that we eat, actually, most of the chocolate comes from West Africa and it's grown by smaller farmers. And the cotton that we exported from Africa to the nice, shirts that we wear is grown by smaller farmers. And the list will go on and on and on. So those companies are out there. They exist. Companies do exist that make money for their shareholders. Now we need to double down on those companies and invest in those companies, provide the right financial tools, and let those companies and more, grow. But this notion that no one makes money in ag actually makes the discussion about adaptation even even more of a science fiction, because you don't even reach the stage of discussing adaptation because they shut you down from the get-go when you talk about ag.
Beyond doubling down on these companies, is there a communication problem? How to get the story out there?
No, I think we should celebrate those successes more. And not many people know that there are companies that were born in Africa, built by Africans, and now they are billion-dollar companies in Africa. No one talk about them. Of course, it took them years, ages, like decades, but they do exist. Come to Africa and do business in Africa in the ag space and make money. And believe it or not, our fund is perceived as an ag first fund. And then climate adaptation is the cherry on the top. The discussion we're having around climate adaptation is nothing compared to the discussion we're having around the agri space, the sector itself.
How do you describe it?
We are an ag fund that invests in companies that help farmers adapt and become more resilient to climate change. That's who we are.
So neither one is first. It's both.
We're a fund that's about making financial returns to our investors, risk-adjusted returns to our investors, while delivering impact on those farmers, helping them adapt and become more resilient to climate change. So
I've seen that you referenced Steve Jobs' 2005 Stanford commencement speech about connecting the dots. Looking back now at your entire journey, starting from Cairo to material science to the development of patents to Cargill to responsibility, and now founding and managing ARAF in Africa. What are the dots that connect for you? How did all of those experiences, all those seemingly disparate chapters, lead you to this moment where you're building a pioneer climate adaptation fund?
if 30 years ago you had told me that I'll be managing a fund like ARAF, in 30 years I would have said, you're crazy. Come on, doesn't make sense. I know nothing. When I interviewed for Cargill, I didn't know that there is white corn and yellow corn. I knew that there is corn on the cob and popcorn. These are the corns I knew. And I always tell my friends that 30 years ago, I understood very well how atoms interact. Now I understand that a chicken needs 120 grams of feed to lay an egg every day. And I understand the economics of growing a fish and so on. And I think it was more of an evolutionary process. I don't think it was revolutionary in any sense. It was just evolutionary. When I left the university to start a business, it was the moment when I realized that, no, I was not born to be a professor. I was born to be a researcher. I was born to solve problems. And in the US, actually, less than 15% of those who have PhDs in engineering work in the academia. So I didn't know that until then I realized that you can have a PhD and do other things in life, and you are still okay. I was fascinated by the whole concept of startups that at that time in Egypt, no one heard of it. Now, yes, we have a vibrant, ecosystem, but then didn't exist. We didn't have many options back then. So moving from the academia to startup, it was evolutionary. It was not revolutionary, right? When you are in the startup scene and you talk to investors, etc., and you start looking at financials, etc., deciding to do your MBA is, again, it's not revolutionary. It's evolutionary. And when you're doing your MBA and you realize that you're good in strategy, you're good in investments, and your professors are encouraging you to do that, and then you find that you fell in love with finance and you decide to do that, again, evolutionary. Even when I joined Cargill, I told you the story and how I ended up there, and I learned the sector. And once I learned the sector and combined that with what I learned in business school, and 6 years later, it was natural to translate those skills into private equity. And from private equity to the fund managing is just different ticket sizes. And yeah, that's it. So it's as simple as that.
Tamer, I've got some short answer rapid fire questions for you before we wrap up here. Don't overthink these. Just give me whatever comes to your mind. And if nothing does, feel free to take a pass, because that's okay too. If you had to name the single most important challenge in the climate adaptation and resilient agriculture VC space at this time, what would it be?
I think awareness.
What do you know now about investing in resilient agriculture that you wish you knew in 2018 when you joined Acumen to found ARAF?
I wish I had known that it takes longer time to build those businesses, what we thought at that time. It takes longer time.
This is a investor podcast, and we're always interested in investments. You don't have to name names, but can you describe an investment you made that you were convinced of at the time you invested? It ticked all your impact boxes, but in the end, it didn't turn out.
I have one in mind. Well, I cannot name names, right? Because we still have the portfolio. But yes, we have one that we thought that it will be a star in our portfolio, and it did not. And we have a lot of lessons learned around it.
What was the lesson learned from that? What do you do differently in your investing process, maybe to prevent a recurrence of that?
Yeah, I think I would do something that I usually do, and I did not in that investment, which is following my gut. I did not follow my gut.
Oh, really? So it was intuition, something felt wrong?
Yes.
Yeah. Now I'm going to ask you the converse of that. We always like to talk about the great investments we made, but can you describe an investment that you had some level of skepticism about at the time you invested, or maybe so much so you actually passed on it. And in the end, it turned out way better, had much more impact than you ever would have thought. And you were pleased you invested, or if you had passed on it, you regret that you didn't invest. And what was the investing lesson you learned from that experience?
Yeah, there is one I can think of. It went really, really well. We knew that it has the potential to go well, but definitely exceed expectations, because I think we were too cautious estimating the risks associated, and many of them did not mature, and the business did really well. So we are in the risk management business. We have to identify those risks and try to mitigate them. And if they don't happen, good and well. And that
is there something you would do different, or that you do different now because of that experience?
No, we'll still be as cautious as possible when we assess transactions.
If someone wants to get into the climate adaptation and resilient agriculture VC investing space, how would you advise them to start, or where should they cut their teeth?
I don't think it's different than any other fund. We're like any other fund. We just have this extra layer during our DD and during our impact measurement process. That's it. Otherwise, it's like any investment. We're looking for good founders, good entrepreneurs, good businesses, good markets, and then cross our fingers and toes.
So you wouldn't recommend first getting a good foundation in finance at a bank? You just jump right into it at some fund?
Not necessary. I've seen brilliant investment officers that started their careers with the big fours, accounting firms, just learning the discipline, learning to become structured, learning financial statements, and then become amazing investment officers. I've seen multiple paths, and I've seen materials engineers become impact investors. So I don't think there is one size that fits all.
Tamer, this has been fascinating for me. Your journey from Cairo to corporate Africa to founding a pioneering adaptation fund is extraordinary. You're building something genuinely new here. And thanks for taking the time to dive deep with us today. I've really learned a lot.
Scott, thank you so much for having me. It was very stimulating discussion. Wishing you all the best.
Before we wrap up here, tell everyone where they can find out about all the great things you guys are doing at ARAF and connect with the work that you're doing.
Yeah, absolutely. We have our website is www.araf or ARAFfund, ARAFund.com. You can find us on LinkedIn, and we have stories about our farmers, etc.
Is LinkedIn the best way for people to reach out to you directly?
Always the best way.
Everyone should definitely check out ARAFund.com. Is that right?
Correct.
It's not two F's, one F.
One F.
Okay. ARAFund.com.
Correct. And on LinkedIn, Resilient Agriculture Fund.
And follow Tamer on LinkedIn. And Tamer is spelled T as in Thomas, A-M-E-R. And his surname is El-Raghy. That's E-L-R-A-G-H-Y.
Correct.
So, all right. Tamer, thanks so much for coming on today.
Thanks, Scott. Have a great day.
Tamer, thanks again. Goodbye, everybody.
Bye-bye.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.